Hi there, this is Alvin from Dr. Wealth. The Berkshire Hathaway AGM ended last week, and as usual, Warren Buffett has shared his wisdom and his investing philosophy to the audience. But one of the issues with that is usually his advice is very general, right? He doesn't really give you stock tips, but it is possible to quantify his philosophy into a few steps, which I will share with you in a moment, and that will give us a list of stocks that would have passed Buffett's criteria. And one of the key things that he mentioned in the last AGM was this: the economic goal of Berkshire is to increase operating earnings and decrease shares outstanding. So what this does is that it increases the value per share of a company. Not necessarily Berkshire, but any company that does this would increase the value per share. And if the fundamentals improve, that should follow by the increase in share price eventually, right? They may not happen at the same time, but if this happen over a sustained period of time, the share price should follow the improved fundamentals, right? So with these are some of the principles that we will put into a more screenable or quantifiable kind of criteria. And the first step, as I will be sharing with you, is this, right? So based on what he said, okay, so operating earnings must grow over time. And this can be put into a screening rule such that a positive operating earnings compound annual growth rate, which is CAGR, is more than 0 over the last 10 years, right? And why do I choose 10 years? Because I want to see a sustained period of operating earnings growth. It's not just 1 or 2 years of growth. It should be consistent over a long period of time. And as well as why don't I set a number? For example, minimally 5% or 10% earnings growth rate. The reason is because we will do the ranking later, right, which I will explain to you how it is done. But at least it must be positive, because if it's not positive, means that operating earnings have not grown over the past 10 years, right? So at least we eliminate majority of stocks with operating earnings that don't increase. The second criteria is this shares outstanding, right? We want that number of shares to reduce over time. And this can also be quantifiable, right, by looking at the growth rate of the number of shares outstanding. So in this case, we want the opposite. We want negative shares outstanding CAGR, compound annual growth rate, over the past 10 years. Right? So same thing, we want a sustained period of share buybacks. It's also a sign that the company has generated enough cash flow in order for them to afford the shares to be bought back from the market. Right? So that is also another angle to look at it. So with these first two rules, we would have satisfied Warren Buffett's philosophy that he mentioned in the latest AGM, right? Operating earnings growth, lower outstanding shares. Okay. So the next step is to combine both together, right? Criteria 2 and 3, okay? How this works is that what I did was I take the operating earnings CAGR, the growth rate, minus the outstanding shares CAGR, okay? In order for me to get a combined number, right? Because as much as possible, we want the growth to be high, we want the number of shares to reduce as much as possible. So for example, if the operating earnings growth is 4%, and the shares outstanding declines by 2%, right? So that would mean that a combined value of 6%, because 4 minus negative 2 give us a 6%. Okay, so with this combined number, I can then rank the stocks from the highest to the lowest, and the stocks that are at the highest ranking would then satisfy the criteria that Warren Buffett is looking at, because these are the stocks that are able to do a much more balanced job in increasing operating earnings at the same time reducing the shares outstanding. Okay, so that is this ranking system that I created based on what he said. And of course, over the years, we know that Warren Buffett shared a lot more his investing philosophy, and it's not just those two criteria that we talk about, right? So it goes beyond that. And one of it is he has an issue with size, right? Because as Berkshire Hathaway grew in size, it's very difficult for it to buy small caps, right? You have to delist it, privatize it, and you need to find many small caps in order for Berkshire to utilize its capital fully. And therefore, the company cannot be too small. So I set a market cap of about minimally 50 billion, because that is the size that Berkshire is looking at. Of course, as an individual investor, you don't have a constraint of what Berkshire Hathaway is facing, and you can lower this number if you want to, right, when you're doing your own screening. Lastly, I also say that it's not just for Berkshire's case, but typically a company has a moat should be a rather big size company, right? It's because the company has competitive advantage. It's not easy for other companies to take a pie out of it. So it should have a considerable size in this case. So hence, setting a minimum market cap is not wrong, okay, even for individual investors. The number 5 criterion is that it should have durable moats, correct? That's what Warren Buffett always said. But this concept of moat is very subjective. Okay, investor A may think that this company has a moat, but investor B thinks that the moat is not enough. So it can be very subjective. How I would deal with this is that I would just rely on Morningstar moat rating. And Morningstar have 2 moat rating, narrow or wide. Right, so wide is presumed to have that durability in the moat, that the moat will last a longer time than the narrow one. Right, so we will focus on the company must be given a wide moat rating by Morningstar. So that would settle that moat concept that Warren Buffett professed. And the number 6 criterion is that we will only do it on US stocks, okay? Because if you take a look at Berkshire Hathaway's portfolio, there are many US companies. And 4 years ago in 2020, that's the COVID year, Buffett also made that statement, say never bet against America. And even in the latest AGM, he did say that he is very unlikely to invest overseas, and majority of investments, even the new ones, are likely to be in the US. So that would ring fence the universe of stocks to just US. And with these 6 criteria, I narrowed down to 31 stocks that pass all these 6 criteria. Okay, so this is the list of stocks, and I covered some of them up. And if you are interested to get the full list, I'll give it for you for free, right? But you would need to click on the link below, right? I'll send you the full image, the uncovered one, the exposed one, okay, 31 of them to your email, right? So the link is in the description box below. And we can see that there are some stocks like even Berkshire Hathaway itself passed the 6 criteria, and we have Visa, Apple. These are stocks that are already in Berkshire Hathaway portfolio. So I would say that it seems like this screening criteria does meet Buffett's investment philosophy. Okay, so you give it a try, right? You might even get the same results in that case. But if you want a shortcut, you can always click the link and I'll email it to you. And how did this portfolio do? This is a backtest. Okay, this is a backtest of the 31 stocks that are screened out. And over the past 10 years, you can see that the Buffett-inspired portfolio, which is the blue line, has gained about 21.31% per year. Okay, so that's pretty fantastic. And over the same period, S&P 500 did 12.15% and Berkshire Hathaway did 12.48%. So actually this Buffett-inspired portfolio did better than Berkshire Hathaway's returns itself. So I would say that it is interesting, right, as a starting point, but I would also take a pinch of salt over these results is because there's look forward bias, right? So actual result going forward may be different, okay? But of course there are always limits to such backtests, okay? But at least the backtest must deliver a good result, otherwise there's nothing to talk about. And number 7, lastly, is that Buffett also say it's important to buy a wonderful company at a fair price, right? It's not to overpay. There are good companies, but they are usually traded at expensive valuation most of the time because other investors can also recognize its excellence. So they are not, they don't have a problem paying up for such stocks. But valuation is still key, right? Make sure that you have a margin of safety when even you buy excellent stocks. So in this case, again, valuation is very subjective. And to make things easy, I'll use a Morningstar valuation model. And it has a 5-star model. So 1 star means that it's overvalued. Then 5-star means that it's undervalued. And I choose at least 4 stars and above, right? So at least 4 star seems like it's not expensive, it seems fair. Okay, so that's how I determine whether the stock is at a good value to buy, right, using a more objective method. So end up, I'll only have 4 stocks that pass the criteria out of 31 stocks that got passed through the first 6 criteria, and on a 7 criterion, I only left with 4 stocks. Okay, the number 1 stock is Adobe. Operating earnings growth is fantastic, plus 31% per year for the last 10 years, and it has been doing share buyback. Share outstanding has reduced by 1% per year, and it has a white moat rating by Morningstar, and it has a 4-star valuation rating by Morningstar as well. So that's the first one. Second one is Starbucks. And yes, operating earnings growth of 10%, shares outstanding reduces by 3% per year, white mode rating, and 4 stars valuation. Third one is Zoetis. This is the first two I don't really mention much, right? Because they are quite well known, Adobe, Starbucks. But maybe this Zoetis is not as popular and not as famous as the first two. So this Zoetis is animal pharmaceuticals, right? So they make drugs for animals, can be your pets, including your dogs, your cats. So it is it is a market leader in its field basically, and it does have the moat, right? Previously it was a Pfizer, so it's a spin-off from Pfizer. Operating earnings growth of 11%, shares outstanding reduced by 1% per year, white moat rating, 4 stars valuation. Last one is also a pharmaceutical company, Gilead Sciences, and operating earnings growth of 8% growth. Shares outstanding reduces by 2% per year, white mode rating, and also 4-star valuation rating by Morningstar. So hopefully these are some initial ideas for you to look at, and basically what I tried to do is to formularize Buffett's philosophy into something that is tangible and easy for you to use. So I hope that you appreciate the process, and hopefully you find some new ideas and do share with me, okay, when you do your own screening. So I'm translating Buffett's folksy philosophy into a quantitative strategy, and ultimately it serves as an initial screen, right? Even though the backtest results is good, it doesn't mean that you should just buy based on this quantitative screening, right? And because another Buffett's advice is that you must know the business well, right? Otherwise, you are not in a position to really invest in the stock. So when you have the screen result, look through the businesses, those that you understand or you try to understand, right? If it's really too difficult, ditch it. Okay, move on to the next one. So hopefully by doing that due diligence, you will be able to find good stocks that can reward you handsomely over time. Thank you for watching. I hope this has been useful for you. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.